Good evening, everyone. This is Brady Pelzer, Executive Vice President, Exclusive Annuities. Wanted to hop on this Zoom this evening to address a hot button topic, something that's come up a lot in our discussions with clients at Exclusive Annuities, the concept carrier Delaware Life. We'll dive into it. S&P 500 driven, getting very advantageous crediting and leverage on the S&P 500 fits well in an accumulation model, as well as a flexible supplemental distribution retirement income model. We'll dive into both utilizations. Prior to, if you're new or unfamiliar with exclusive annuities, again, Brady Pelzer, Executive Vice President. If you are unfamiliar, feel free, go check out our site, exclusiveannuities.com. You can see it here. Better retirement, better you. That is what we do. We help individuals navigate the questions, all of the considerations that come with retirement, the proverbial flip of the switch, deciding this is the time, no longer working. Do I have enough? What expenses should I anticipate? Feel free again, exclusiveannuities.com. Our founder and president, William Rapp, my business partner. And then there's myself, again, executive vice president, right here through the site at any juncture during this call, during this meeting. If you want to book a call, right here on the site, exclusiveannuities.com, book a call with William, book a call with myself. Also, when you go in and book, you type in your name. This is my direct cell and email. Feel free to reach out directly as well, but you would go through. If you would like to meet with each of us, right here in the comments, just notify us. Would like to meet with William and Brady. Right there, I'm not a robot. Boom, confirm appointment. Again, exclusive annuities. If you want to book with William, same thing. Click on a time, able to book an appointment, a strategy review session. Also, check out our YouTube. This is an example of one of our videos posted on our YouTube feed. We're constantly producing content to make everyone out there, as well as specifically our clients, aware of the changes in not only the indexed annuity landscape, but also in the overall financial circuit in and of itself. All right. And again, like, subscribe, hit that button. Book an appointment, a strategy review session with William and myself today, diving into Delaware Life right here. You can see the website, very clean feel. If we go into the product discussion, two products, really the same vehicle, just named differently for the different duration of the chassis itself, the duration, the term of the contract. We have our target growth 10 and our retirement stages select 5 and 7. So these contracts are available on a 5-year basis, a 7-year basis, a 10-year basis. We'll touch on the differences, not too much different, but we will touch on the differences, starting with the target growth 10, issues 18 to 80, $25,000 minimum, can utilize qualified as well as non-qualified and Roth monies. It is a flexible premium. Most indexed annuity contracts are single premium. You're only allowed to make that initial payment. And then if you were looking to put more money towards that product, that contract, you would have to open another contract. This chassis Here with Delaware on all of their durations, 5, 7, and 10. It is a flexible premium chassis. We're able to continue contributing to this contract, the concept in and of itself. And that's really what I want us to pay close attention to this evening, as well as consistently. If you're working your way through the videos, we talk concept at Exclusive Annuities. A lot of the time, when you meet with a financial practitioner, you'll have a pie chart, a bunch of pie charts, a lot of aesthetics in the presentation, projection this, projection that. Here at Exclusive, we like to look at the cold, hard facts as a concept, identify when we forecast through our forecasting process, we identify concepts that have the best puncher's chance to accomplish our clients' goals. Ultimately, nobody knows what's going to occur from a gross economic market standpoint from now and in the future. We like to deal with the cold, hard facts, identify in your retirement the guarantees, really focusing, harping on contractual guarantees, contractual propositions. We look at the gross proposition. Again, Delaware Life, a good example on their 10-year chassis. Here we have our surrender charges. If we go up to the rates here, first, the index allocations, where exactly are my funds placed within this contract? We have the S&P 500 index. Again, we're focused with the Delaware chassis on the S&P 500 leverage. But we also have the Goldman Sachs Canopy Index based on U.S. equities and treasuries. The First Trust Capital Strength Barclays 5% Index, again, based on equities, not just reserved to the United States, but the majority would be domestic. Also looking into the foreign marketplaces in Germany, as well as Japan. Franklin SG Select Index, U.S. equities, treasuries, 1 year, fixed rate. Previous video that we have recorded will show you, we dive a little bit deeper into the construct of an annuity. What does all of this mean? How is this blended between equities, treasuries? Highly encourage, if you're wondering what goes into the design of one of these indexes or indexed annuities, highly encourage you to, again, go to our YouTube page, source out the video. All right. And then on the 5 and 7, we will see, again, this is why the concept is identical. Although they have different product names, the concepts are identical. We have the same S&P 500, Goldman Sachs, First Trust, Franklin, and the 1 year fixed. Now, again, we're going to really dive into the S&P leverage within these contracts. Diving into it, always like to get an illustration put together. Run it in the state of Nebraska. That is where I am based out of Omaha. Exclusive Annuities. And we're going to run this example on a 65-year-old individual in the state of Nebraska putting $500,000 of qualified monies into this plan. Valued client for these purposes. Every client is valued. And while I'm getting this punched together, to tell you a little bit more about why we like Delaware Life, A- rating. So they are on A paper, according to AM Best. Big reason why We like Delaware Life. It's a concept called, and it's unique to the annuity marketplace, renewal rate integrity. Renewal risk is a risk unique to the indexed annuity marketplace. Dive into that a little bit deeper, what that means, how Delaware carries itself, conducts itself with further integrity than most every other carrier in this space when it comes to renewal rates. And again, here, $500,000 coming from an IRA, qualified monies. And this allocation first, we're going to put 100%. This is called the S&P 500 trigger. Mechanism there, if the S&P 500 is up any which way positively year over year within the contract, you will get the specified trigger rate. Again, year over year. So today is July 31st. If we hypothetically say this contract, Delaware Life Target Growth 10, your Delaware Life Target Growth 10 contract issues today, July 31st, your contract will track the earnings of the S&P 500 from July 31st of 2024 to July 30th, end of the day, close July 30th, 2025. If the S&P 500 is positive year over year, could be 0.01%, as long as it is green, you would get the specified trigger rate of 8.75%. That's what that rate is set at within the 10-year chassis with Delaware Life, the Delaware Life Target Growth 10 first year rate, 8.75%. It's a 1-year index tracking earnings over the course of 1 year. Again, 1 year. If the contract were to go to issue today, July 31st, to next year, July 30th, if the S&P 500 is positive, you would earn 8.75% in your contract. Now, we'll go back to my earlier note, renewal rates. Delaware Life carries themselves with a great deal of integrity when it comes to the renewing of their crediting rates. That's what this is. Within an index, you'll have a crediting rate that comes in the form of a performance trigger, as shown here, a cap rate, which specifies that you'll earn up to a certain point within a specified index. So if this were an 8.75% cap, you would earn up to 8.75% of the S&P's earnings. Meaning if the S&P 500 did 8.75%, you would earn all 8.75%. If it did 10%, you would earn 8.75%. If it did 20%, you would earn 8.75%. The performance trigger is different from the cap in that, again, it's a trigger mechanism. And so this is where we get the leverage on the S&P 500. If the S&P 500 does 0.01%, you get 8.75%. Yeah, if the S&P 500 does 15%, you still get your specified 8.75%. That's where we could look at a participation strategy where you're a participant in the S&P 500's earnings, no cap on those earnings. We'll dive into that in just a moment. But again, S&P 500, 1 year performance trigger. If the S&P 500 is any which way positive year over year, you will get the specified performance trigger that first year, 8.75% renewal rate. At the end of that first year, because it is a 1 year index term, Delaware Life has the discretion to lower or increase that 8.75%. You will get a renewal rate upon the renewal of your allocations term. That's all a lot of hogwash of saying at the end of 1 year, this 8.75% could be lower. It could be higher. Delaware Life is one of the, again, carries itself with the most integrity in the annuity marketplace. They generally, in a 10-year contract, at least historically, have more than a 90% hold on these rates. What that's saying is if you take this 8.75%, multiply it by 0.9, that's saying at least historically how Delaware Life has treated existing money rather than new money. This would be considered the new money rate on existing monies. At least historically, if it starts at an 8.75% trigger rate, historically, Delaware Life will not lower that any more than 7.85%. They have a 90% hold on the initial crediting rate. That's at least historically. Delaware Life also was one of the last carriers to publish their renewal rates. Nowadays, that information is tightly kept by these carriers. They do not make it public to the general public. So there's no means to externally track the renewal rate history, track record of a carrier. Delaware Life was one of the last carriers to discontinue publishing their renewal rates. It happened in the most recent 24 months. Carried it on for quite some time. Again, 8.75, you can see the growth. What this is run on are real returns in the S&P 500 over the last 15 years, run through the most recent month end. Again, what that's saying is that July through the month of June of the years 2009 through 2013, or excuse me, 2023, 2009 to 2023, tracking July through June performance in that sequence. This is the past performance. What that tells us is that at least historically, July is a good month to get into the S&P 500, at least again, historically. So we see it there. Let's look at it now in a distribution model rather than guaranteed income, where much like a pension, you're trading the asset's value in for a guaranteed lifetime income. We at Exclusive Annuities like to look at flexible income, flexible distribution models in retirement, retaining utility, use, and control of the asset. Again, utility, use, and control of your asset, being able to maintain a sustainable distribution flow, focusing on growth. If we take that same 500,000, specify a free amount withdrawal, generally We don't like to go anywhere over 7% from a spend down of the asset standpoint if we are going flexible distribution. This example, a very strong target would be 6%. However, taking it on a fixed schedule, always like to do it on a fixed basis, 6% of your initial premium, 500,000 would be 30,000. Let's look at that same model with distribution in mind. So we create, and this is on a guaranteed basis. What this reflects is zero earnings in the S&P 500 for the next decade and ongoing. But realistically, in these contracts, it's a 10-year chassis, will be within the contract for 10 years. Best to look at going a different avenue at the end of the terms of these annuity contracts. If you presently have an annuity contract nearing the end of its term, again, schedule a booking with myself and or William, exclusiveannuities.com. That's a great time to schedule and initiate a strategy review session if you are nearing the end of an existing annuities term. Go to booking, but 0% returns through and through. So if this scenario were to play true, one, I always joke that I would be living in Switzerland. But outside of that, you're going to be happy that you are in an indexed account, because what we're seeing here are zeros, again, guaranteed. Any indexed annuity that William and I show you has principal protection. What that means is if the S&P 500 is negative for your contract year, you will get a 0% return. Zero earnings, zero losses, principally protected. Again, leverage on the S&P 500. We're a participant in the ups, but we are not a participant in the downs, the downturns. So this realistically illustrates a significant depression. These are generally negative and sometimes significantly negative figures rather than your zero. Even on a guarantee basis, you see that 30,000 a year, because your asset is preserved, your principal is protected, it's still sustainable. Yeah, your asset is going to run out because there's no growth. But now if we look at it with growth, and again, based on the most recent 15-year cycle of the S&P 500, we can see on a 6% fixed spend down, $30,000 a year, we're able to create that income stream for yourself to complement your Social Security amongst potential other income sources. We're able to produce that distribution without touching your principal. You'll hear it all the time from us at Exclusive. Don't touch your principal. That's what we're aiming for. Efficient distribution models that may be on a non-guaranteed basis, but and historically play out better for clients. We're able to create income as well as continue to have and maintain an asset that is readily available for utilization. Again, readily available for utilization. So that is one concept, the S&P 500 trigger. Now just want to go back to the illustration software, punch in or scatter across these S&P 500 options for ourselves. All right. Right back to that guarantee ledger, or excuse me, go here. So here now we have the S&P 500 trigger, the same one we were just referencing, but we've added the S&P 500, same 1 year term, the cap strategy, and the participation strategy. The cap strategy, again, we and touched on it a little bit earlier, 11.25%, 11 and a quarter. If the S&P 500 does 11 and a quarter, you would receive 11 and a quarter. If the S&P 500 does 5%, you would receive 5%. That's where it's different between the performance trigger and the cap is on the downside. If the S&P is positive, but not fulfilling the entirety of the cap rate, the performance trigger, if it's 5%, you get 8.75%. If it's 5% in the cap, you get the 5%. Now, on a participation basis, you are a participant, an uncapped participant in the index. What that means, if the S&P does 10%, you would get 6%. If the S&P does 20%, you would get 12%, 30%, 18%. You're an uncapped participant. If the S&P ripped off for 100% in a year, you would get 60% of earnings. Again, guaranteed ledger, principal protection across the board. Very worst case scenario, in an indexed account, you will receive 0%. You can have that certainty that your nest egg is preserved at the very least. But again, we have the growth capabilities because we are a participant in the upside of the S&P in the market. No downside. We have downside protection with upside participation. That would be the 10-year chassis. And again, just want to show you the rates. So keep in mind, 60%, 11 and a quarter, 8 and 3/4. Actually going to jot that down for myself here. 60% participation on the 10-year contract, 11 and a quarter, as well as 8.75 on the trigger. We pull up a new illustration software. We'll type in the same scenario. However, this time we'll place it in the 7-year chassis. And for today's purposes, we'll show the 7-year chassis. With the understanding that the 5-year, the correlation between the crediting rates, how those correlate if the contract's duration is longer or shorter, is the same for the 5-year. Same 500,000. And we'll do the same scatter in which we saw previously, 33 in the cap, 33, excuse me, in the participation, and 34%, a third across the board. And we'll take a look at, again, the crediting strategies, crediting rates. Same strategies, different rates. Again, same product, different name, but same product from a structure standpoint. Just lower crediting rates because it's a shorter contract duration. Your asset is only due surrender charges if you were to walk away from it for 7 years in this one. The retirement stage is 7, rather than a 10-year wait before the surrender charge schedule matures. So you'll see that the same for the 5 year, 60% participation in the 10, 55% participation in the 5, similar in the 5 year. It would be a lower participation rate than what is available in the 7. There's a trade off in the contract durations. The crediting rate that the carrier will give you is directly correlated with that duration. Excellent. And again, check out our website, book your strategy review today. Go here, exclusiveannuities.com, book a call with me. Cannot wait to get connected. If you need anything in the interim, again, feel free. Go to our site. Go to our site. Sign up for your strategy review session today. Sign up for myself, William, both of us. Make a note. Let us know if you would like to meet with both of us. Check out our YouTube, some other videos, products, propositions that may be a fit for you, your profile. Check out our softwares or life cycle model. Brady Pelzer, Executive Vice President, Exclusive Annuities. Appreciate you taking the time this evening and do look forward to getting connected soon.